and welcome to The Chart Show. I'm Victoria Scholar. Each week I'll be sharing my analysis on three key stories that are getting a lot of interest among investors. I'll be breaking them down not just from a fundamental perspective, but with technical analysis on the charts as well. This week's three charts are the pound, which has been suffering after the Bank of England kept rates on hold at the end of last week, IAG, the parent company of British Airways, which reported earnings ahead of flights being reopened to the United States, and Uber, which saw shares jump more than 4% after earnings. After much uncertainty heading into the decision, the Bank of England surprised some economists and analysts by voting 7-2 to keep rates on hold, prompting Governor Andrew Bailey to be described as the second unreliable boyfriend, the first being the former governor, Mark Carney. The central bank has postponed the first interest rate hike since August of 2018, delaying liftoff since a raft of monetary stimulus measures were brought in at the start of the pandemic. Clearly, the central bank wants to wait for further data to come through on the labour market rather than bringing about any economic strain through hawkish policy in its combat against inflation. Nonetheless, it's likely that the next meeting could be live with a possible rate hike in December or at the start of next year. The Bank of England is now anticipating a worse inflationary environment next year with a weaker growth picture as well by downgrading its forecasts. The pound suffered its worst week since June, pushing down to multi-week lows. Let's take a look now at the chart of the pound against the US dollar, or cable. Despite the counter move higher at the start of October, the pound has in fact been trading in a descending trend line with lower highs since the peak in June. And in order to believe there's more downside to come, look for a break below the September low just above 134, which could create another lower low and an extension of the downtrend. It's been a very volatile period for the pound, with a sharp move lower in the latter half of September, followed by a retracement of almost all of that drop on expectations of a rate hike, followed by another significant drop when it became clear that the November rate hike was off the cards. However, with growing expectations for a rate rise in the coming months, there could be potential for another move higher. The next major resistance is at 136, with a break above potentially paving the way for further near-term gains up towards 138. On Monday, travel restrictions were finally lifted for UK passengers travelling to the US, with British Airways' parent company reporting results just one trading day ahead of the reopening. Shares in IAG had a volatile day of trade, initially jumping by more than 4% on Friday, but closing nearly 2% lower. It guided for a full year loss of €3 billion, which was bigger than analysts were expecting. The shares were initially lifted by comments from the CEO of BA, who struck an upbeat tone, saying he's, quote, very optimistic that transatlantic travel will reopen with higher capacity next year. The group CEO said he expects to restore 100% capacity by next year, restoring levels not seen since before the pandemic. IAG also said that North Atlantic bookings surged ahead of this week's border reopening. Meanwhile, the company, which also owns Aer Lingus, Iberia and Vueling, said its third quarter loss reached €485 million, which was slightly better than analysts were expecting. It was a volatile session for trade for IAG on Friday, with shares swinging between gains and losses, ultimately to close in the red, with investors digesting both the positive and negative comments in the quarterly figures. Taking a look at this weekly chart, we can see that after the dramatic COVID sell-off in Q1 of 2020, the stock has attempting to regain ground with an ascending trend line and higher lows. However, since the peak in March, shares have failed to make a higher high and instead have made a lower high. Until we get a lower low below the most recent trough, the uptrend still remains intact. But in order to believe that there is further room to run on the upside, we need to see a higher high, firstly above the October peak at 191 and then above 223, the March peak. Overall, it looks as though we're still a long way away from retracing the COVID drop, and in fact, before the pandemic, during much of 2018 and 2019, there was already some considerable downside pressure on the stock. So arguably, the long-term downtrend remains in play. Shares in Uber jumped more than 4% despite initially trading lower in the post-market session after hours. Investors cheered its first ever adjusted profit figure, with group revenue up 72% year on year on the third quarter. Nonetheless, it still reported a quarterly net loss of $2.4 billion, impacted by its investment in Chinese ride-hailing firm Didi, which had disappointed in its IPO in New York this summer amid the regulatory crackdown from Beijing. Uber still reported a top and bottom line beat, with gross bookings in ride-hailing up 67%, while food delivery bookings were up 50%. CEO Dara Khosrowshahi suggested that taxi business will be making a comeback after COVID, with a drop in waiting times and a fall in surge pricing. Let's take a look at the chart. After the COVID sell-off last year, the stock quickly breached its pre-pandemic highs, reaching all-time highs in February of this year. However, since then, the stock has been struggling to create fresh highs, instead creating a descending trend line, which saw the stock temporarily break below support around 40, around where the stock market was trading in February of 2020, just before the market turmoil. However, since September, the stock has been attempting to regain ground, with the next key resistance level at $50. If it can break above that level, then Uber has the potential to log a new high above the June peak, just above $52.